We shall commence this module by studying about arbitrage pricing theory. The presence of price discrepancies among equivalent securities in different markets can be used to earn riskless profit through simultaneous purchase and sale of the securities in these markets. Such an exploitation of the security mispricing to earn profit is called arbitrage. The equilibrium capital market hold the basic principle of no arbitrage condition. That is, the equilibrium market price do not allow for the arbitrage opportunities. Perhaps there would be pressure to restore equilibrium in case the actual security price allow for arbitrage. Possibly, a simple relationship between expected return and risk could be derived by combining the factor model and the no arbitrage condition of the equilibrium capital market. Such a trade-off between risk and return is known as arbitrage pricing theory. After studying this module, we shall be able to know the concept of arbitrage pricing theory, explain the principle of arbitrage, learn about the arbitrage mechanism, know about the arbitrage portfolios, and then finally we will compare APT with CAPM. Now we are starting with knowing about the arbitrage pricing theory. The CAPM is an excellent representation of the process by which stock prices are determined, but it is not perfect. The underlying assumptions of a CPM may not hold well in the real world. Also, there are serious doubts about its reliability. Moreover, CAPM is a single period model based on the market factor influencing the security's return. An alternative to the above equilibrium asset pricing model is the multi-factor asset pricing model purely based on the arbitrage argument. It is the arbitrage pricing theory model developed by economist Stephen Ross in 1976. The key point behind arbitrage pricing theory is logical statement that security returns are not based on one single factor of the market. Rather, it is influenced by multiple macroeconomic factors where sensitivities to each factor is represented by a factor specific beta coefficient. The arbitrage pricing theory model proposes that there exists a linear relationship between the return on asset and the number of risk factors. Although the arbitrage pricing theory model does not specify what these risk factors are, but assets returns are linearly related to the risk factors. In an article in the Financial Analysis Journal, Richard Roll and Stephen Ross state specifically that arbitrage pricing theory assumes that a security's long-run return is directly related to its sensitivities to unanticipated changes in the four macroeconomic variables. The first is inflation, second is industrial production, third is risk premium, and the fourth is the scope of the term structure of interest rates. Assets, even if they have the same CAPM beta, will have different patterns of sensitivities to these systematic factors. APT also emphasizes the law of one price, which implies that the two securities will command the market price given that they are equivalent in all economically relevant respects. In other words, in an equilibrium market, that is, with no arbitrage condition, the two identical securities having same degree of risk will have same price, that is, will have same return in the market in the long run. However, in the short run disequilibrium, there may be differences in the market price of securities having same amount of risk. This would induce arbitrage activities by the arbitrageurs until the arbitrage opportunities are eliminated. Our model is based on certain assumptions. So now we are going to discuss the assumptions of arbitrage pricing theory model. It relies on the following assumptions. First, a factor model can be used to describe the relation between risk and return on security. Second, there are sufficient securities to diversify away idiosyncratic risk. The third, efficient and well-functioning security market do not allow for persisting arbitrage opportunities. Arbitrage pricing theory model, how formulated. Now we are going to discuss the formulation of arbitrage pricing theory model. The arbitrage pricing theory postulates that there exists a linear relationship between the expected return of a security and the various macroeconomic variables. The model holds the fact that the security returns are affected by a variety of risk factors instead of a single factor, that is index of the market, as in the case of CAPM and the single index model. However, the APT model does not spell out these factors, but it is assumed that the relationship between security returns and the factor is linear. According to arbitrage pricing theory model, return on security I is given by the following equation. Ri is equal to E within bracket Ri plus beta I F1 plus beta 2 F2 plus so on beta In Fn plus Ei. This is first equation. In this equation, we have used Ri, the rate of return on security I, ERI, expected return on security I, Fk, k is equal to 1 to n is the macroeconomic factor. Beta Ik is the sensitivity of the ith security to the kth factor. Ei is unsystematic return on security I. For this above equilibrium to hold true, following conditions must be satisfied: that E within bracket Ei and En is equal to 0 for all I and n where I does not equal to n. E within bracket Ei and Fk should be equal to 0 for all stocks and factors. Ross derived the following relationship, which is called the arbitrage pricing theory model. This equation can be summarized like this: that expected return for the ith security is equal to Rf plus beta I1 plus Rp1 plus beta I2 Rp2 plus so on beta In Rpn. This is the second equation. In this equation, we have used Rpk is equal to E within bracket Rfk close the bracket minus Rf and close the bigger one. It is the risk premium for the kth systematic factor, that is the excess of return on the kth systematic factor over the risk-free rate. The model asserts that the investors want to compensate for all the risk factors that systematically affect the return of a security. The compensation is the aggregate of the product of the sensitivity of the security to each risk factor beta I Fk and the factor risk premium, that is E R Fk minus Rf. The rate of return thus derived from the model will then be employed for pricing the assets correctly. The asset price shall be equal to the asset price at the end of the expected period discounted at the rate derived by the model. Any divergence in the price of the asset shall be brought back to the line through the process of arbitrage. Now we move further to discuss about the arbitrage principle. The arbitrage pricing theory is based on the principles of arbitrage. Arbitrage is the practice of earning riskless profit by taking advantage of price difference between two or more markets without making any net investment. In other words, the arbitrage is the process of simultaneously buying and selling of an asset in two different markets having different prices. The arbitrage makes a sure short profit with no risk by buying in the market having low price and selling in the market having high price. It also implies that if due to certain imperfections the securities with same risk level exhibit different returns, the investor should sell the security with low return and buy the security with high return. A combined effect of the investor's utility maximization thereon, homogeneous belief of investors and perfect market is that the securities are priced efficiently in the long run. The arbitrage opportunities exist in a situation where the payoffs or expected return from an asset is identical to an asset that is priced differently. The arbitrage relies on the fundamental principle of finance, that is law of one price. This law states that two identical securities with same level of risk, that is variance 1, must have the same price, that is mean return for each of the security must be same. However, the two identical securities might be priced differently because of the short disequilibrium and imperfections prevailing in the market. But this is possible only in the short run. This price difference in securities shall open the way for arbitrage opportunities in the market. Such an opportunities would be grabbed by the arbitrageurs and they shall engage in arbitrage activities. They shall simultaneously buy the securities where it is cheap and sell where it is expensive, bidding up the asset price where it is low and forcing down the asset price where it is high will be continued until the arbitrageurs' opportunities are eliminated completely. Thus, the securities shall be priced efficiently in the long run. The notion that the market prices will move to maintain no arbitrage opportunities is perhaps the most fundamental concept in the capital market theory. Now we move on to the arbitrage mechanism in arbitrage pricing theory. Arbitrage mechanism in arbitrage pricing theory model involves simultaneous trading of two assets, one of which is mispriced. The mispriced asset is the one whose current price is different from the price predicted by the model. An asset is correctly priced if the price is equal to the sum of all future cash flows discounted at the rate of return specified by the APT model. The expected return derived in the APT model is linear function of various factors and sensitivity to changes in each factor is depicted through factor specific beta coefficient. The arbitrageurs engage in trading between the correctly priced asset and mispriced asset by selling the asset that is relatively too expensive and buying the asset that is relatively too cheap and thus making a risk-free profit which is equal to price differences between assets. A correctly priced asset here refers to a synthetic asset, namely portfolio consisting of other correctly priced assets. Such a portfolio is exposed to the macroeconomic factors in the same manner and extent as the mispriced asset, that is, the synthetic asset has a beta per factor equivalent to that of mispriced asset. The investor, by simultaneously holding long position in asset and short position in portfolio synthetic asset and vice versa, earns a positive expected return that has net zero exposure to macroeconomic factors. The expected return thus earned is difference between the asset return and portfolio return. The arbitrager thus makes a riskless profit by taking advantage of price difference between mispriced asset and correctly priced asset. Now we move on to discuss about the arbitrage portfolios. The arbitrage theory postulates that the investor attempts to increase the return from the portfolio without increasing the funds in the portfolio. At the same, he wishes to keep the risk at the same level. Suppose the investor holds a portfolio of securities A, B and C and wants to change the proportion of securities without making any change in the financial commitment. The increase in the proportion of one security is possible by denoting XA, XB and XC. An increase in the proportion of one security is possible only when there is a decrease in the proportion of other security. Since the financial commitment is not increased, an increase in the proportion of investment in security A is possibly only if he reduces the proportion of investment either in security B or C. The changes in proportion of investment in different securities will add up to 0, which is a basic requirement of arbitrage portfolio. If X indicates the change in the proportion, then we have delta XA plus delta XB plus delta XC is equal to 0. This is the third equation. The factor sensitivity in arbitrage model represents the responsiveness of a security's return to a particular portfolio. The sensitivities of the security to any factor are the weighted average of the sensitivities of securities. The weight of the sensitivities is the change in the proportion of securities. In an arbitrage portfolio, the sum of the sensitivities becomes 0. This can be shown by the following equation, that is B for A asset change in A asset plus B for B asset change in XB plus B for C asset change in the C asset, that is XC is equal to 0. This is the fourth equation. In this equation we have used BA, BB, BC, these are sensitivities, and delta XA, delta XB and delta XC are the changes in the proportion of securities. Also, the expected return in an arbitrage portfolio should be greater than 0. Change in XARA plus change in XBRB plus change in XCRC is greater than 0. This is the fifth equation. Now we are moving towards to understand about the APT and CAPM model. Both these APT and CAPM are prominent theories on asset pricing. Both theories give promising results in capital budgeting, security evaluation, investment performance evaluation. In fact, APT has several advantages over the CAPM. It is less restrictive in its assumptions as compared to the CAPM. The CAPM is a single factor model and is derived by assuming an inherently observable market portfolio that is difficult to construct. In contrast, APT model argues that one single factor cannot correctly influence the risk and return of security or portfolio. Rather, the security, risk and return is influenced by a set of multiple factors. APT is thus called a multi-factor model. The CAPM assumes that investors utilize a mean variance approach. On the other hand, APT assumes that the asset prices can be influenced by factors beyond means and variances. In a way, CAPM may be called a special case of APT, in that the security market line of CAPM reflects a single factor model where beta is the sensitivity to market movement. CAPM and APT cannot be compared because CAPM is based on single factor model and APT is based on multiple variable model. The only similarity in these two models is that both talked about the market sensitivities. In spite of the several advantages of the APT model, the APT model does not fully overcome the CAPM. Since APT focuses on the no arbitrage condition without the assumption of the market or index model, the expected return beta relationship for any particular asset cannot be ruled out. The CAPM and APT are not really at odds to each other. The two models are in fact complementary to each other rather than competing. Both the models assert positive expected return results from the factor sensitivities to the market movement and vice versa. Now finally, we are going to make a summary of what we have discussed so far. We have started our discussion about discussing the average or the APT model. The arbitrage pricing theory model developed that security returns are influenced by multiple macroeconomic factors, where sensitivities to each factor is represented by factors specific beta quotient. The APT model holds that there exists a linear relationship between the return on security and the number of risk factors. The third is we have discussed that the expected rate of return thus derived from the arbitrage pricing theory model will then be employed for pricing the asset correctly. Then we have discussed the model emphasizes the law of one price and no arbitrage condition in the long run. Then we have discussed that arbitrage opportunity occurs when there are differences in asset prices in two or more markets.